Hi guys, a very good afternoon and welcome to CNBC TV18's Mumbai newsroom. I'm Pavitra Parekh. With me is Sonal Bhutra. You guys are tuned into Mutual Fund Corner. And as we come to a close on this year, on 2022, we bring you our last mutual fund show for this year. And today we're going to look at a fund house that has given us some of the best returns across categories. They've fared way better than the category average and are sitting at an easy rank 1 or 2 across scheme segments. So Sonal, at a time when, actively managed funds have found it so hard to beat even the benchmark, I'm interested to know what they're doing right.
Oh yes, I am as well, right? So let's not waste any time and get to the guest as well. We have with us Mr. Sandeep Tandon, who's the founder and chief thought officer at Quant Mutual Fund as well. Sandeep, good afternoon. Thank you so much for joining us, and season's greetings to you and everyone at Quant Mutual Fund as well. And that's exactly my first question, right? Because we were talking about how this has been a very volatile year. Nifty is up around 4% year to date, and most of the actively managed funds, so to say, they have not been able to beat the benchmark as well. In that case, you have clocked in good returns. So what is your secret sauce?
So Sonal, actually we practice a very dynamic style of money management. When we say dynamic style of money management, it's a very data driven. So we analyze the data very closely, and we look at the much larger macro perspective. We try to understand what type of environment we are in and accordingly try to implement our strategy. So we look at the work on a concept of predictive analytics. The predictive analytics gives a perspective when you combine multidimensional research. It gives you a better perspective how the big macro picture is looking, and accordingly we design or reconstruct our portfolio. So we all know that we all live in a very dynamic in the world, but our portfolio management style can't be static. So that's the way we brought the concept of dynamic style of money management, which is based on the multi-dimensional reports, and then we run multi-variance model, and that's the way we generate alpha or superior risk-adjusted returns.
Okay, Sandeep, good afternoon and thanks for joining us. I'm definitely going to ask you more about your investment strategy, and we'll really get, to how you go about it. But before that, I want to ask you about your tagline, which is very interesting, which says multi-asset, multi-manager. Do you want to explain this to us?
Yeah. So the entire philosophy of Quant Mutual Fund revolves around risk mitigation. Okay. So how well you manage your risk. So when we're talking about multi-asset, multi-manager, we brought this tagline keeping in mind that we are dealing with multi-assets. A lot of people think, I'm dealing in equities, what I have to do with crypto, what I have to do to look at the global macros. Okay. So when you're talking about multi-asset, we bring from the research perspective, the interlinkages between various asset classes, and which is very helpful when we talk about our predictive analytics model. And when we talk about multi-manager as a concept, which means that we are not dependent on one human being, one money manager, or the portfolio management, what you call it. Neither we are dependent on one thesis. So we bring a multi-dimensional approach here also. So we give weightage. Instead of looking at just one aspect, which is pure valuation analytics, we look at the concept of liquidity analytics or risk appetite. Okay, so one money manager specializes in valuation analytics. Somebody else will look at purely on the liquidity analytics, and third will be looking at the risk appetite, which is sentiment, which in turn will be dissected further down. And so it's a team which delivers, because as a house we believe that we should produce specialists rather than one money manager, because it is actually not fair to expect that one human being can understand everything about the market. The expectation from a very portfolio manager is actually on higher side. So we brought the concept of multi-asset, multi-manager. Whole idea is to remain very focused and specialist and not dependent on one style or one thesis or one way of looking at the markets.
Okay, so one of the interesting frameworks, so to say, for you is VLRT. That is basically valuation, liquidity, risk appetite, and timing. Can you explain this strategy? How does it work for you?
So as I said that like in my 30 years of career, we have been only taught, fundamental is everything. Okay, when I say fundamental, the way people look at it is purely on the valuation analytics. Yes, valuation is the backbone. We call it fundamental, the Atma, liquidity, the prana, and sentiments, the Maya. This is a core belief of Quant when we constructed this VLRT framework. So we take only 1/3 weightage to the valuation analytic, which is a predominantly your normal cash flow based analytics, which we talked about. Then we also combine other two analytics, which is liquidity and risk appetite. See, let me give you, which is 1/3 weighted each. Let me explain you the rationale behind that. See, the challenge is about the valuation analytics alone is that you get very good entry point, but you don't get exit points. Okay. So because you are too biased, and we all as a human being get biased with certain views, because in the valuation analytics, the biggest challenge is that it is dependent only on one dependent variable called price. And if price changes, everything changes. So the whole thesis of VLRT framework is that how to remove the biases of this dependent variable price. So we brought the concept of bringing independent variables into it, which we captured through valuation analytics, which captured through liquidity analytics and risk appetite, which are predominantly a macro data. It has nothing to do with the prices of a stock or sector or any indices. So that way we are able to remove human biases. So we give 1/3 weightage of each of the analytics, which is valuation analytics, liquidity analytics, and risk appetite. When all three analytics are skewed on one side, it gives me better timing. So timing is a function of all three analytics, and timing, this whole thesis of timing, when we talk about our VLRT framework, is actually a risk mitigation framework. And that's the way it helps in generating superior alpha with limited risk.
Okay, got that. Sandeep, I'm going to sort of dive a little bit more into that last part which you mentioned, which is on timing. You know, every time we have a guest on, or when we talk to anybody from the industry, the first thing they say is, don't try to time the markets. You're probably not going to get it right anyway. Your theory is a little bit different on this, perhaps because your investment strategy looks very different. But do you want to elaborate on this when you say time is everything when you invest?
See, when we talk about timing, timing is a risk mitigation tool. Okay, let me give you a small example. Okay, it will give you better perspective. Let's talk about 2021. We were the few house who talked about globally that in September 2021 we have seen a euphoria in global equities, and that's the time we look at, when you dissect this euphoria, we said it's a euphoria was a technology stock, growth stock, or the new age companies, not in the value. So we exited technology stock in September 2021. And we bought, if you look at our portfolio, we bought aggressively banking, and ITC was number one stock in the portfolio. Until today, it is one of the largest holding. So it gives you a perspective, because in September 2021, technology stocks were trading at the most admired category. When you say it has reached that the limit of outperformance, which we look at from a behavior perspective, it peaked out there, which means the outperformance will stop on a relative basis. And where banking was showing signs of early stage of recovery, and ITC was the classic neglected territory. It has been the most hated zone. So if you look at, this is the way we define timing. We define timing through mathematically. It's not about the gut feeling. It's not about our view which we are forming on opinion, or it's not from any trading angle. Rather than looking at any momentum in the market, we try to capture the inflection points in the market. Extreme levels we are seller, and extreme levels we are buyer. So extreme greed, we try to reduce our exposure. Extreme fear, we try to capitalize and go long. So timing is a function of multi-dimensional approach. When we analytics are skewed on one side, it gives me better timing. So timing is a risk mitigation technique, and we believe timing is everything in life. If you really ask me, every investor, every manager, or every trader, or every business house wants to time the market. Is there in the subconscious mind, but we don't want to accept it. So we are very candid in our opinion. Timing is very, very vital, and we link timing from a risk management aspect rather than anything else.
Okay, so that's an interesting take actually. Is that the reason why you think churning is good for any portfolio? Is that what takes your decision through that process as well? Why do you believe that?
See, I tell you, the churning, there is no word like churning in any portfolio management books. Okay, we have been taught wrong things because we think everything is long term. Okay, I'm very vocal about it. See, the equity and asset class is very long term. Sector and stocks are not. Okay, so if my environment is changing, since as I said, we live in a dynamic world, so money management style also has to be dynamic. So if risk on environment or risk of environment is changing globally, or macro data is changing, I'll prefer to rebalance or reconstruct our portfolio, and that is what we call it dynamic rebalancing. Industry call it churning, we call it dynamic rebalancing. If you look at purely from the academic point of view, it's a rebalancing approach which we bring on the table. And as a mutual fund, if I am able to reduce the risk for my clients or my investors, what best option is available to us, and we will capitalize on it. So churning is not at all bad, rather it is very effective. See, churning should not be linked with the trading. Okay, so a lot of people link the churning with the trading. No, we rebalance our portfolio in a dynamic way, it can lead to more turnover. Answer is yes, but mathematically, it really helps me in reducing the risk.
Okay, so you were referring it to, referring to this as rebalancing more than churning, and really that does change the way the entire statement sounds, right? Sandeep, very interesting chat, but I'm going to ask you to please stay on for just a minute. We have to take a quick break, but lots more questions when we come back.
Welcome back. You're still tuned into Mutual Fund Corner, and we still have with us Mr. Sandeep Tandon to discuss their exemplary performance this year, that is of Quant Mutual Fund. Sandeep, we've been talking a lot about timing, a lot about changes in the sector preference as well. So according to you, what would the big theme or sector that we'll see in 2023, anything that has your preference?
So we have been talking since 2019 that 2021 to 2030, or the current decade, actually globally belongs to the value as a thesis. Okay, and it has really delivered. If you really look at September 2021, I was explaining earlier, when we saw euphoria in global equity, where risk appetite started declining, liquidity peaked out. So that's a cycle where the growth stock from a valuation multiple perspective has peaked out. We are very constructive on the value as a thesis when emerging market is a part of that thesis, which means into 2021 till 2030, if I have to get a larger perspective, and obviously 2023 is also part of that, where the emerging market will outperform the developed market, and the Asia-centric emerging market particularly. Okay, so we are more optimistic and bullish on India, both on absolute and a relative basis. Within India, we like to play value thesis, neglected, beaten down territory names, okay, where valuations are relatively very cheap. We have seen under ownership, okay, or neglected territory, grossly under research names. So those are the theses I think will play out as compared to people have been chasing growth at any price, or mostly admire category stock, which did very well between 2012 till 2021. So that phase of for nearly a decade, that phase peaked out. So it's an opportunity to capitalize. And the larger thesis we like, I always say, the manufacturing is the big picture which is emerging for a decade perspective, or maybe half a century perspective, and anything revolves around manufacturing. So I'm talking about a larger perspective thesis. Obviously, banking is the one thesis comes out. When you talk about capital good or industrial, they're all interlinkage, engineering, okay, infra as a space, metals as a space, okay, and even the cement as a cycle we like. So I think the way I have to look at the market, I think what has changed globally in last 1 year is that the tightening cycle has actually peaked out. From a global perspective, a lot of people will find it very difficult to digest. This is what our predictive analytic and data is endorsing. The global tightening cycle has peaked out, and liquidity easing cycling has begun. And China is the first country where we have seen easing sort of thing is happening. And similarly, the risk appetite, which was declining from 2021, has also bottomed out. So risk appetite for various asset classes and various countries has started inching up. What it means that the valuation multiple for equity and asset class will expand as compared to general consensus of contraction. This is purely on data which I'm talking about. So we are more constructive on 2023 relative to what we were in December 2021, and we talked about 2022. We were slightly concerned about 2022, but as we are knocking the doors of 2023, situation looks better. But I also said that one should not forget that we are still in the volatility expansion phase. I always talk about this concept that employed walls of the global asset classes will remain elevated between 2018 till 2023. This was the outcome of our predictive analytics models we have been talking about. We call it volatility expansion phase, which means that 2023 can be equally volatile or can be more volatile than 2022. And one should be prepared for that. So the whole thesis is how you generate extra alpha by sector rotation, stock rotation. And that's a thesis will play out because one has to live with high level of volatility. And if you don't optimize this volatility scenario, then you run the risk of underperformance.
All right, that point is absolutely well taken. Sandeep, since we are talking about sectors, what's not done well in the past years, of course, IT. I know after the very strong rally that we saw post-COVID, but IT has definitely been under pressure. You have a lot of these new age, newly listed companies which saw sharp cuts, valuations corrected significantly. Do you think this is something that will continue into 2023 as well? And would you look at any of these companies?
If you ask me, we downgraded or we exited technology sector or new age company. We never participated in a new age company, but technology we used to have very large exposure. So September, October 2020 when we exited, and till date we have not turned constructive from a core position. Maybe tactical bets we keep on playing, that's a very different issue. But if you ask me whether this sector has bottomed out in terms of they have reached a neglected territory or their earning cycle which has peaked out, has bottomed out, no. So answer is big no. I think this sector has more pains, okay. But you will see tactical bounce and people will play for that. But if you ask me from a core perspective as a core holding, we like to skip this phase. I think other opportunities are far superior because given the background of technology stock Nasdaq, given the over ownership which the sector has, I don't think it has reached from a behavior perspective, that neglected zone where we get generally comfortable, which is the case, let's say in PSU banks, or which is the case was there in defense, or which is the case is still there in some of the infra names or some of the other neglected territories.
Okay. Sandeep, we briefly spoke about how you are more bullish on 2023 than you were on 2022 when we were talking about outlook as on December 2021, right? So suppose today you have $100. How would you split it in various sectors? What would your allocation strategy be?
See, as a house, obviously, we invest in our own schemes. That's the best way we can capitalize. And the way I will like to, since I'm a reasonably, we are not very I'm personally not very aggressive investor, but my risk profiling is on the medium side. The way I will play as a combination of a portfolio where I will select my mutual fund scheme in such a manner that I'll get both mid, large, and small caps exposure, and also will like to capture through our thesis, whether we look at, let's say, value is a decade call. So we like to have good exposure to our value as a thesis. We like infra as a theme. So we like to have a infra fund in our exposure, but as a thematic fund, we should not invest more than 20% of exposure. So we like to have this exposure, given the background which we are, the flexibility plays a very big role. So we like to put money in the flexible schemes also. And even on the other schemes, like the hybrid schemes you talk about, or like the way we have quant absolute fund or quant multi-asset fund, that's another opportunity which we see. And if somebody is looking at a combination approach and I have a very medium to near-term perspective also, then quantum also. So I will place a combination of these schemes rather than just saying in one schemes I would like to participate. I'll also like to diversify my portfolio so I get a better risk-adjusted returns.
Okay, got that. Just one final question, Sandeep. We track this mutual fund data that comes through every month. We have seen SIPs consistently going up month after month, but flows into equity mutual funds have been coming down. In fact, last month there was, quite an outflow that we saw from large caps as well. What is your reading of this data, and how do you expect this to look in the coming few months?
See, if you really ask me, majority of the schemes have actually in last 1 year, if you talk about particularly, have not able to beat the benchmark. Okay. So obviously, which is the pain point for retail investor, and with the rising interest rate environment, if they're unable to generate positive return, it's going to hurt them. So general perception, a lot of people think SIP is a long-term perspective. Yes, it's a long-term money, but the type of investor which is putting money, their risk profiling is on the lower side, and they put in their hard-earned savings out there. So at least when we interact with a lot of retail people, we have seen a disappointment out there. So I think if the underperformance continue, I think money will slow down this space. So I think the key aspect, we have to live with the expectation in delivering alpha, because the real retail money in the rising interest rate environment, it becomes a very tricky situation.
Hey, Sandeep, words of wisdom. Thank you so much for joining us today and explaining to us your strategy, what the outlook is. Wishing you good luck for 2023 as well.
Thank you.
All right, with that, it's a wrap on this edition Mutual Fund Corner from Pavitra and I and the entire team, of course. We wish you all a very happy new year, and we'll take a break now. Closing bell will come up next to take you through the last hour of trade.